Hello everyone, my name is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical systems trading algorithms like you see here on our SPY system. Been doing this since 2003 for individual traders, as well as professional institutions, some of which I consult with on a weekly basis. Okay, so let's get started. I have two videos I'm going to record today at Super Bowl Sunday. And this newsletter here is going to be specifically on the general market indexes, indicators, bonds, and sectors. I'm going to be doing a second video today that will be on the commodities and especially precious metals. All right, so let's go ahead and get started here. So this is my newsletter backend format that I record for our newsletter subscription service. You can see our recorder here. So I'm going to go ahead and start this, and I'm going to pull this out of the way. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone's had a nice weekend so far. It's Super Bowl Sunday. I'm sure a lot of you have plans for that. I'm going to try to get these newsletters out before the Super Bowl starts, but many of you may watch these after that. I'm doing two newsletters this weekend, one on the general market, which is this one, and one on commodities specifically. Okay? Got a lot to cover here, so let's get started. You can see this general market newsletter is divided into three major sections. Actually, four major sections. I got a typo here. But we're going to look at, my opening comments here. We'll look at the general market indexes in depth from the big picture all the way down to the smaller time frames. We'll look at bonds, indicators, and review the major market sectors. All right. So, again, first thing I want to talk about here is so far this year has been the year of commodities. And I predicted this back in December when I showed the bullish symmetry breaks on the energy sector, specifically like XLE and oil services. And I also discussed this over a year ago back in December 2020 when I made the case that commodities may be entering a new bull market. Commodities actually led last year. The DBC commodity index is up almost 44%. That was far better than the S&P, which was up about 27%. But you can see so far, here's what's happened this year. The S&P down 7.3%. Nasdaq, triple Q's down almost 13%. Small caps, IWM down 9.5%. But look at commodities here. DBC, that's the index, up about 11.3%. Crude oil up almost 24% for the year. Energy, these energy stocks specifically, those are what have been leading. XLE up about 27% this year. Think about that, guys. That's what the S&P did last year, the whole year. It's already up 27%. Oil services up almost 33%. Those are huge gains on a yearly basis, and we already got that in about a month and a half. All right. Other commodities, coffee up 11%. I don't have soybeans on here. I think that's up 16%. The ags are doing well. So commodities have led, and I do believe that, we are still early stages overall in some sort of commodity bull market. Okay. We'll show you some charts on that below. But as far as the market, what we pointed out the extreme negative divergences last year. They actually started in July of last year. And then after making new highs in November, they really became obvious, the negative breadth in the Nasdaq. You also seen basically a stealth bear market under the surface with something like 40% of the stocks in the Nasdaq were below their were at new 52-week lows and down over 40%. So, all of you know that, especially if you had stocks like Peloton or Snapchat. Hopefully you guys didn't write that stuff down. But a lot of this extreme negative bear market warning signs were showing up last November, before Thanksgiving, and in December. And then, of course, we got the big sell-off in January. And the market, the S&P put in a little tradable bottom late January, and it's been extremely volatile since. A couple weeks ago, I thought we had a trade low in. We put in a bounce. We got to the 61.8% fib retracement where we found resistance. That's a logical place to find resistance. Then last weekend, Steve gave his opinion. He favored more upside. And we got that. We got that until Wednesday when the S&P retested the 61.8% fib. But it failed to follow through. So the tone changed on Thursday. Then we sold off Thursday and Friday hard. In fact, on Thursday's newsletters, I said the onus is on the bulls. And, they didn't, the football analogy, they weren't able to recover the football, and we sold off hard on Friday. You had all kinds of things such as, all this stuff over in Europe, the Ukraine, inflation data from the CPI, all that stuff negatively impacting the market. So the S&P, again, stalled right at its 61.8% fib. It closed back below its 200-day moving average. The triple Qs on Thursday morning tested the 200-day moving average and found resistance there. The Russell back tested its previous loss support from Thursday, okay, which became resistance. So the onus is on the bulls, and clearly the tech area, that needs to stabilize for the market to have some sort of tradable low here. There's a lot of concerns here about a bear market, things like that, and there's definitely a lot of evidence for that. What I'm really concerned about here is very short term. Is the market going to go back and take out January's lows, or can it hold up here and chop around? That's still what I favor for now. I know we got all this geopolitical mess with Europe, with Ukraine. I still think Putin's probably not going to do anything in the short term. Here's an article, you can read about it. But, longer term inflation, that's a huge issue. We all know. But, again, short term here, I think we could possibly not go back to those lows, but we'll see. Longer term, there's a lot of problems, and I'll show you that in the charts. So enough talking. Let's go ahead and start looking at the images. So item number 2 shows the index sector table, what transpired on Friday, and of course for the week. Friday and Thursday were ugly days for the market. You could see Friday's action. The Dow was down something like 500 points. The S&P was down 85. Big down day. And for the week, mostly down except for the Russell, which was up 1.5%. As far as the major market sectors here for the week, not as bad as you think here, kind of mixed. Clearly the weakness is in these tech area, technology, semiconductors, communication services. Still some strength in the banks, and energy, of course, has been just on fire this year. Like I said, XLE's up about 28% for the year. All right. The dollar, US dollar, up 0.67%, big rally on Friday. And that didn't hurt gold, which had a big move. Now, by the way, gold, precious metals, which I will be discussing in the next newsletter, that area looks potential for a big trend change. But we've seen false starts there before, and how much of it rallied on Friday because of the Ukraine, we'll see. But I'll take a look at it in the next newsletter. Bitcoin, cryptocurrencies, they were down for the week a little bit. They had a big week. They rallied into some resistance. I'm not surprised to see them pull back. They did break their downturn symmetries, though, a couple weeks ago. Commodities, mostly to the upside, as you can see, except for copper, which was down, which was up for the week, but down on Friday. But nice gains for commodities here, with only natural gas down for the week. Everything else up big. And precious metals had a big week, especially on Friday. Gold closed up almost 3%, silver up 5%. Those are big moves. And GDX, the miners, outperformed, up 6.8%. Big moves in the bonds and treasuries. As you know, the 10-year hit that 2% last week. It did pull back. Now, if we can get a pullback in that area, that might help the market here short term as well. Next, item number 3 shows the economic news calendar for this week. Plenty on the docket here. As you know, we had the CPI data on Friday. On Tuesday, we have PPI. And, of course, we still have earnings this season. Okay, let's go and jump to these charts. First chart below, item number 4. This is a ratio chart of the CRB, that's the commodities index, to the S&P. All right, I've been showing this chart for a while, and again, I'm going to cover this more in the commodity newsletter video, but commodities have been underperforming here since 2011. You can see it on the ratio, but you can see this rounded bottom that's formed. Started last year. I talked about this in late 2020, and it really if you just look at the chart here, doesn't it really look like it's curling up here out of a nice rounded multi-year base? The moving average ribbon, which as you know is a great guide, it's been negative for all these years, but it had flipped back in here. It's still pretty pinched, but it's trying to curl up here. Everything is really set here for a major trend change that could last years, for example. So this, I think, is an area, commodities, to focus on, maybe like the 70s, who knows. Next. Chart number 5, gold. As I said, gold, we've had a lot of false starts from it lately, but it is trying to break a coil here. Again, we'll see how much of that was due to Friday's, Ukraine stuff. But everything's set here with the coil, with this ratio, and the moving average ribbon. I've talked about these ribbons. When they're pinched like this, energy is pent up like a coiled spring ready to pop. So it's really set up to run if it wants to here. So we'll see if they can get follow through. Next. Image number 6. Here's the yield curve. Again, this is something, as I've stated since last year, we got to keep an eye on. The yield curve keeps tightening. Look at where it was just mid last year. The ratio was way up to here. Now it's down to 1.28. This is an inverted area. It's not that far. The economy's definitely been slowing down here. You got to keep an eye on this if this goes inverted. Next. Chart number 7, here's another way to look at it. This is the difference between the 10-year and the 2-year, and it closed at 0.42. Again, when it goes inverted here, that usually precludes some sort of recession in the future. It's kind of funny that it actually went inverted here for a very short time in late 2019. It's almost like it predicted that pandemic, which we got in March 2020, just 6-7 months later. Kind of interesting. But this horizontal line here, I've found that usually when it falls below this level, it's pretty much destined to go inverted. So it just seems like it's in the cards to eventually happen. Next. Image number 8 here. This is the January stats, which I already covered, but January this year ended down 5.3%. And again, I compiled all these January stats. They say that as January goes, sometimes goes the year. Well, not exactly. It kind of depends on, what your prior consecutive years were. So 2022, the previous 3 years were up years. And in this past, it hasn't happened very often. Whenever you had a down January and the 3 previous years were up year, you had a down year. And it just makes sense from a, common sense standpoint. You were up 3 years in a row, so you're probably due for some sort of consolidation, right? Obviously, if you've had 4 up years or 5, same thing. It's whenever you only had 2 up years or 1 up year, or the previous year was a down year, then the stats, didn't really matter. In fact, a lot of times you had an up year. But this tends to give higher odds that the 2022 will close down. Again, a lot can happen between then, up and down. I expect this year to be extremely volatile. Next. Chart number 9. This is the chart Steve and I have been discussing since last fall, back in August. This is a monthly chart of the S&P, and it has, the focus here is on our moving average ribbon. All right. We talk about these moving average ribbons. It's on all of our charts. This one has the BPTMA Deluxe here, which is a custom moving average. These here are exponential moving averages, the 9, the 20, 34, 50 exponential. So again, moving average ribbons, it's a pretty simple concept. When they're bullishly stacked, or, they'll go through periods of contraction and in periods of expansion. When they contract, energy's bent up. That's when you're due for big moves up or down. But when they get too wide, you're due for a consolidation. And you can see how wide this is. This is something that concerned Steve and I way back in August, September, how wide these things are. Again, this is a monthly chart, so each candle is 1 month. We've now had 2 down months. But even with the last 2 down months, it hasn't healed at all. My concern is that for this to go through a period of contraction, even like you see back here, 2015, this could take a year to 2 years to occur. So that's why I think the market's going to struggle in the longer term, because this is going to take a while to work off. Next. Moving to some other longer term charts. This chart shows you a monthly view of the major indexes. Again, so far we've had 2 down months, as you can see. Approaching the middle Bollinger Bands in the Nasdaq here. Still a ways away from the S&P and comp. Next. Chart number 11. Here's a quarterly view. So each candlestick represents 1 quarter. But look at my comments back in November. I talk about how the slope, this uptrend slope, was just unsustainable. It just makes sense. Things have been vertical since that March 2020 low. And this was unsustainable. And so far, we have a nice down quarter. Again, not surprising. This type of action, you don't just run straight up without some sort of consolidation eventually. Next. Chart number 12, here's a quarterly view of the S&P. And you can see my comments back in early January. The new year, this steep uptrend slope is unsustainable. Eventually, a consolidation will occur. So those are my comments back then. And so far, we're consolidating here. But we're still way over the mean. The 9 EMA is your short-term mean. That's still way down here, a little below 4,000. So again, just common sense, this slope, unsustainable to maintain, so it may need a period of long consolidation to work that off. I like to view it like this, guys. Think of the markets when they go like this. It's like a sprinter, or it's like yourself. If you run out take a sprint as fast as you can, you eventually need to pause, rest, catch your breath. That's how the markets are. Next. Chart number 13, here's a weekly view of the major indexes. So you can see how the action is since the early January. We've had this correction. 2 weeks, we had a 2-week bounce from late January. And then last week, decline on most of these indexes, except for the Russell. But the Russell stalled right here at previous support, became resistance. So, next. Chart number 14, here's the Dow. We don't look at it very much. It's only 30 stocks, but here's the Dow. It's been stronger than the other indexes now. As of Friday, it too closed below its 50-day and 200-day moving average. Here's the moving average ribbons on these charts. You can see they get too wide like they were here. You're at trade bottoms, okay? But that rally up allowed the moving average ribbons to pinch. The bearish view is you have an ABC bounce up into here. I added fibs here. So you can see the Dow a little below the 38% fib. The 61.8% fib would be down here at 34,161. Next. Chart number 15, here's a monthly view of the S&P. Again, already showed the monthlies, but we broke this uptrend line here in January. And right now, we're right at the 9 EMA on the monthly. Okay. If we break this, the 9 EMA over time, then this 20 could be a target. Next. Chart number 16 is another monthly view. This focuses on these 2 moving average ribbons, or 2 moving averages, the 8 and 13. They've been a pretty good longer-term guide. I don't trade by these, but you can see overall these 2 moving averages on the monthly time frame have caught these major bull markets, bear markets. And since 2000, when they crossed back bullish here, late 2009, they've stayed positive. They went through periods of consolidation like here and here, but they've stayed positive. And we commented about this late last year, how wide these 2 ribbons, moving averages are. And that may need now time to consolidate, kind of like you see back here. All right. So is it just going to go through something like you see here, where you go sideways for a year or 6 months, or something more bearish like you see here where they actually cross? We'll see, but just common sense. They were so wide there. they needed to revert back to the mean. And they still haven't reverted back to the mean even with this little consolidation we have. It's going to take time. This is a monthly chart. Next. Chart number 17, here's a monthly view of the S&P. This is, we had that bear market in 2008. And essentially, if you want to call this still a bull market from the 2009 lows, you can see this uptrend channel. Bear markets are essentially corrections of previous bull markets. So let's say we have a major bull market high in here. Bear markets will usually retrace at least 38% of the bull market. So you'd come in here around 32.30 essentially, if this is the high. All right, just one guide. Bear markets could be deeper than that, like 2008 was, 50%, etc. But it is something to monitor. I don't consider, by the way, guys, bear markets I consider price, consolidation, and time. CNBC calls anything below 20% a bear market. So they would call this correction here in February, March 2020 as a bear market. But to me, I don't count that because that was 1 month. Bear markets aren't 1 month. To me, bear markets occur over a time period, like 2008, late 2007 to early 2009. That was over a year. That's a bear market, not 1 month, 1 or 2 months. That's too short. So I consider that a deep correction, very deep correction in a bull market. So we'll see, guys. We stalled at this upper channel. Now we'll see. Is that the end of the bull market, or can the bulls still recover this damn thing one more time? That's the question. Next. Chart number 18, here's a weekly chart showing the same channel. Here's a wave count that does allow for one more move up. The problem a lot of Elliott waivers have with the high there in December is that you didn't have a real true 5 waves. You only had little 3 waves up. So that still leaves possibility for one more blow off move in a wave 5. Again, technically it's still possible, but the bulls need to recover the football. All right. If the market were to take another big dump and go below January lows here quite a bit, I think that would be pretty much negated. So the onus is on the bulls to make that happen. All right. But I just show you because it's still possible. Next. Chart number 19, here's a weekly view of the S&P. Focuses back to the February, March 2020. I added fibs from that time frame. You can see the 38% fib way down here at 38.15. Again, we did break a symmetry here. This was the largest pullback in the uptrend that began here after the March 2020 lows. So that led higher odds for a lower high, which we did get here. But are we going to come all the way down again is the question. This is your kind of big support area. I think possible we'll chop around here for a bit. If we were going to go lower, I think we chop around first, but we'll see. You can see the 60 stochastic. It did go well below the 80% area. It had held it that whole time. We had a nice MACD divergence up here. These recycling. Moving average ribbon is trying to go negative here. Next. Chart number 20, here's a daily view of the S&P. So you can see this uptrend channel. As you know, we broke through that in December, made this trade low. At the time, we counted this as some sort of trade bottom, and we did. We got a nice rally up to here, which, by the way, was a perfect 61.8% retracement from this high to this low. And you had the back test of this broken channel. So that was a perfect area of resistance to short. Exit your longs if you were trapped down here. I know a lot of people that shorted down here. I think that was the wrong thing to do. Moving average ribbons were too stretched. We were due for the reversion to mean. We got it. But we stalled at resistance. We came down. Last weekend, we leaned to the upside. And we did get one more move up, but we stalled here again. We needed to get follow through at least to here, 50-day, and we didn't. And then, of course, Thursday and Friday sold off. We busted this coil to the downside. We closed back below the 200-day moving average. This is the EMA, the lime one. So the S&P's got to recover the 200-day moving average here, quite honestly. Next. Chart number 21, here's another daily chart. Again, at this moment, I don't favor that we're just going to go and dump to a new low. Again, it could happen. That's just what I'm favoring. Remember, the market's going to do what they're going to do. So you got to trade what happens. But one thing that could happen here as well is some sort of coil where we go sideways like this. And think about it. This would really cause a lot of pain for both bulls and bears. The markets tend to make you extremely emotional, and this would do it. This could break up, or this could be a bear coil and then get your move down. Next. Here's an interesting chart. This channel. Notice we're still sort of in the confines of this channel. Next. Chart number 23, 2-hour view of the S&P. Again, you can see how we stalled right at the 61.8% fib 2 weeks ago. Then last week we rallied and stalled there again on Wednesday. So both, by the way, these were both Wednesdays. This high and this high right at the 61 fib. Then, of course, sold off on Thursday, Friday. Closed right around the 50% fib. The 61 fib here, I would like to see that hold. If that loses, then I think odds would more favor going all the way back to the lows. These are some areas, and this is now resistance, this 44.50. Notice your moving average ribbons, flipped. Next. Chart number 24, 60-minute chart that I've been showing. Again, we stalled dead at that resistance last week. The previous week we stalled there. Again, all at the 61 fib. This 44.50 was a big support where we rallied off of, and then we lost it on Friday. So the bulls need to regain the football and get back over this 44.50, get back over the 200-day moving average, okay? So write that down. That's your area. The bearish view is we had a wave 2 bounce here, and we're going to go down in 3. The bullish view still is this A, B, C, where we're forming another higher low again. I wish I could tell you exactly which one will play out, guys, but both are valid. I still lean that we're going to form a higher low, but again, I could be wrong. Next. Chart number 25, another 60-minute view, shows you the same thing again. Now here we have the fibs drawn from this higher low instead of back here. All right, so you're right at the 61.8 fib. Bulls need to get back over this area to be positive, and then over this downtrend line, which didn't hold last week. Next. Chart number 26, 30-minute view, shows you the same things basically. Next. Chart number 27, 15-minute chart. So last Thursday, when we gapped down in the morning, you had a shorting opportunity right here. We pointed that out real time on the website. We thought we were going to go down to this point. We did. It was a great short. Then on Friday, of course, we were up. And once we lost this area, that was another shorting opportunity. And Fridays and downtrends tend to be weak anyway. Finally, chart number 28. Here's the 5-minute view. Shows you the action the last couple days. We'll see how futures open here tonight. Next. Moving on to the other charts. So this here is the S&P daily KISS system. It is still long officially. There's a DVT stop here at 44.80, so just a little bit below. Now, some of you may have elected to use the 44.50, and so we'll see if this holds or not. But overall, the KISS system does very well when the market's uptrending. It could get chopped up here in times like this. This is your ATR resistance. We'll see if this can hold or not. Next. Chart number 30, here's the various cycle time frames. So we did get a cycle sell last Thursday, that dot below the ATR. That was actually a good little short. We had a cycle resistance here on the half day. It's the 195-minute where we've been stalling, lost the ATR. One thing to watch this week, guys, and I'm going to be watching this, is these cycles on the 2-hour. Lately, price has been following this, and we get a little cycle buy on Friday. On the 60-minute, we lost the cycle, but we have a DeMark 13, so quite oversold there. Next. Chart number 31, here's the triple Qs, Nasdaq. Again, that's really the area to monitor. Remember, that's where all the damage has been. Notice the triple Qs stalled at these moving averages up here, lower high again. And by the way, they had matched this pullback from the highs was symmetrical point-wise to the one back here, February, March 2020. That's quite astounding. The S&P nowhere close to that. Again, this is more bearish for the overall market, in my opinion. You can see their moving average ribbons went bearishly stacked. Next. Chart 32. Here's a daily view. Shows you this channel a little more clearly. We broke that. We stalled up here at the 200-day moving average. And last week, you can see the symmetry there. Next. Chart 33, here's a daily chart. So again, last week on Thursday, we stalled right at the 200-day. And then, of course, Friday, ugly candle. This doesn't look too pretty, guys. We have a potential ABC bounce, which could lead to another new low. Notice your moving average ribbon got too wide here, so we were due for a rally. But when it got pinched up here and you were at resistance, that was a lower risk short. Stalled right here at resistance. This is the problem for the general market. You really need this area to hold up, otherwise it's going to drag other things down. Next. Chart 34, here's a 2-hour time frame. So far, this pullback is larger than this one, breaking a little symmetry. Next. Chart 35, here's the daily KISS chart. So this never did go back long on the Qs. It is out. It went out back here. Stopped out in December, and it's been out since. So this has been in cash. Next. Chart 36, here's the various cycle time frames. You can see we got that sell cycle late last week. It says bearish rally. Moving average ribbon was super wide here, so we got the rally, but stalling here at the pinch, the bearish pinch underneath. Little buy signal on the daily, half day, buy cycle on the 2-hour, quite interesting. And the 60-minute, you got a DeMark 13. We'll see where we open tomorrow. Similar look as the S&P. Next. Chart 37, here's the Russell weekly chart. Again, the Russell started weakening late last year. That was an early warning. We got a break in symmetry here. It gave you high odds for a lower high, which we got here in December. And then we lost this longer term support. And that became resistance last week on the bounce. That's a negative. There's not a lot of support down in here, which is concerning because it could easily work all the way down to here over time. Next. Chart 38, here's the daily chart. Again, you can see the Russell essentially get a 5-wave low here in late January. Little ABC rally into this previous support trend line, which became resistance. Breaking this, watch this trend line here now. Next. Chart 39, here's the 2-hour time frame. So again, we had a little break in symmetry here, higher low, but the bearish view is you simply had an ABC rally. Now, I don't have a 15-minute chart in here. The 15-minute chart still looks actually constructive on the rut. Looks more like an ABC, and the rut actually closed up last week, so that's a slight positive. We'll see how futures open and how the market opens on Monday. So that does it for the indexes, guys. Let's move on to bonds. Chart 40, high yield corporate, HYG. This was an early warning for the market. It started really weakening strongly there in late December. And boy, it still looks ugly. There is a little divergence now. I will say the ribbon here is very expanded. So it's due for some, say, reversion to mean back bounce. Okay. But where this goes, usually the market goes. Next. Chart 41, TLT. This did rally on Friday, so long-term rates pulled back. You know, if this were to try to bounce, that may help the market a bit, so keep an eye on that. Next. Chart 42, there's the 10-year Treasury yield. As I said, it had a nice breakout from this coil, but it did pull back on Friday. Next. Chart 43, there's the weekly time frame. So it did hit that 2% area we've been targeting. This is a potential target over time. And we'll see. Market's clearly very sensitive about this and inflation. Let's move on to some indicators. Chart number 44, here's the VIX. Nice rally in the VIX, but it's still well inside its Bollinger Bands. To me, it's not going to get out outside the Bollinger Bands easily here, just since they're so wide. You can tend to get your bigger moves, market sell-offs, when the Bollinger Bands are pinched more, like they were here in January and, of course, November there, or late November. Next. Chart number 45, here's the VVIX. One concerning thing is this still hasn't reset. It's still well above that 110 area. This gave a fantastic warning, get out of Dodge in the market when it went from below 110 to above 110 here. And that was in late December, early January. Very timely exit. Next. Chart number 46, here's another view of the VVIX. This is my hedging system. When it goes above 110, you hedge. Look at that, caught this high right there. When it gets way outside the bands on these spikes, that you can remove your hedges. And this is something to watch too. If this were to spike outside the bands, maybe that'll put a new low in the market. But it's still way above this 110 area. By the way, guys, these very useful indicator charts like this, if you're a subscriber, Breakpoint Trades, we give you these live charts so you can use them on your own. You can save them as URLs in your browser and view them on your own. Next. Chart number 47, S&P versus high yield corporate. As I stated, you can see how much weaker the high yield corporate has been than the S&P. And all the past years, they have been very correlated to each other, high 90%. So this was kind of an early warning. And this is still a concern because it's much weaker than the S&P. Next. Chart number 48. Here's another chart we like to watch. The S&P large cap versus the small cap advanced line. And you can see small cap advanced decline formed that lower high in early January. The larger cap formed a higher high. That was a divergence, and it played out for this correction. You also had a divergence back here in early September, and that gave you early warning for that correction we had in September. So this is a nice, useful indicator as well. Right now, it's not telling you anything. It's when you get these divergences when you want to pay attention. Next. Chart number 49. This is a chart remember, guys, I talked about all in December. All December in every newsletter. I talked about the difference between the 52-week highs and the 52-week lows. It went negative, and I said, unless this goes back above zero, this was very concerning for the market, and usually what you see before bear markets. And it has never went back above zero. Okay. Next. The reason why we got to keep an eye on it, here's the same chart back in 2007, 8. You could see the difference between the 52-week highs and lows went negative here in late 2007, and it really never recovered. Yeah, it recovered for a bar here, but otherwise it basically stayed below zero until early 2009. So that's why this is a very important chart to monitor. It must go back above zero, otherwise it more points to a bear market. Next. Chart number 51, here's the same chart, but as a daily. Again, you have your 52-week highs here, the lows, and the difference. So even the daily never went back above zero yet. Next. Chart number 52, here's the NYSE equivalent. Now, it hasn't been as bearish as the Nasdaq one, but it's still, you can see it's still negative. It's below zero. Next. Chart number 53, here's the S&P equivalent. Now, this one is more positive. It's still, above zero here, but we want to keep an eye on it. This one tends to lag more. It's not as responsive as the Nasdaq one. Next. Chart number 54, some of these breadth indicators like the NASI. Remember, these started giving warning signs in the market all the way back last fall. And here, when the Nasdaq made new highs in December, this was strongly negative. It just told you that so many stocks under the surface were strongly down or in bear markets. Gave a nice early warning for this correction or bear market we're in. Next. Chart 52, here's a very simple chart to understand. Percentage of stocks above the 200-day moving average. I talked about this warning back in July. It went below 50%, and it was never recovered even when the Nasdaq made new highs here in November. Stayed down around 30%. So right now it's at 20%. Next. Chart 56, here's the NAHL. It gave another warning. This gave a warning back in December when it fell below here. You can see past times. So this was a warning. This is basically the breadth. Next. Chart 57, here's what that indicator looked like back in 2007 and 8. It went below here, and it never really recovered until 2009. Next. Moving on to the sectors, here's the XLE Energy. Again, this sector's led this year up almost 28%. It's still holding this 9 EMA here. It is overbought. I would rather buy a pullback here, but so far we're not getting it yet. By the way, we pointed out this bullish symmetry break back here as a buy signal in late December, early January, and that has played out beautifully. Next. Chart 59, here's your weekly view. You know, broke this long-term weekly trend line a month and a half ago. It's long-term uptrending, guys. Next. Chart 60, oil services. It hasn't been, well, it's basically testing now the highs from last year. This still has a lot to go, but I would prefer a pullback eventually. We'll see if we get it. Really nice move out of that bullish coil. Next. Chart 61, there's the weekly view of oil services. It could potentially have a long way to go. Look where it was back in 2014. Next. Chart 62, semiconductors. Stopped right at this resistance last week. This was previous support, turned resistance, essentially an ABC bounce, moving average ribbon. This looks ugly. This, in fact, looks like it may want to go back to lows. Next. Chart 63, XLC communication sector. It's got things like Facebook and Google and Netflix. So very ugly. It's now back to the lows again. You can see how your moving average ribbons have been great guides. Moving average, bearish moving average ribbon pinch on that bounce. Next. Chart 64, transports. Also stalled last week. Big sell-off, well below its 50-day now, or 200-day moving average. Next. Chart 65, financials, they're stronger, but remember the yield curve tightening does not, hurts them despite the fact that rates are going up. So nice pullback from the dojis here. It's still above its 50 and 20-day for now. Next. Chart 66, retail, stalled at this resistance last week. That's your support. Next. Chart 67, consumer discretionary. It's essentially an ABC bounce back into resistance. Moving average ribbon stalled there too. Next. Chart 68, consumer staples. This is still fairly strong, but making lower highs, closed below its 50-day. Next. Chart 69, utilities. Essentially now maybe in a big coil. 200-day moving average right here. Next. Chart 70, healthcare. Stalled at its 50-day moving average last week. Now the 200-day right here. Next. Chart 71, materials. Also stalled at the 50-day moving average last week. Next. Chart 72, biotech. It's been a super weak sector all last year. And the bearish view here is you have a bear flag forming potentially. Next. Chart 73, real estate. It's weakened quite a bit since the January highs there. Looking ugly. Next. Chart 74, home builders. Big sell-off from that symmetry break I pointed out back in December. So far, these rally attempts have stalled at symmetry. So it's downtrending. Looks like it wants to make another low again. Next. Chart 75, Brazil. This one's still strong. It's got a lot of those commodities in it. Remember, this had a bullish symmetry break back here, and that's played out. Next. Chart 76, Emerging markets still in this choppy downtrend, unable to break these symmetries. Next, chart 77, Bitcoin had a big correction from the November highs. It did break a symmetry in here. So far stalled here. Now we'll see if it can make another higher low or not. Next, and the final chart, Ethereum stalled at 50-day moving average here, pulling back. We'll see if it can form a higher low. Got to keep an eye on the cryptos, guys, because they've been kind of leading the market as well. And that does it. There was still quite a few charts here to cover, and I do have one more newsletter coming via the commodities. Take care and enjoy the Super Bowl.